Good day. We are Group 8, and for our short video on a management account concept, we have chosen dividend payment policy. What do we mean by a dividend payment policy? The dividend payment policy is simply the way a company structures its dividend payments to shareholders. Generally, companies choose to set a dividend payment policy as a percentage of earnings per share, which is called the dividend payment ratio, DPS/EPS. There are various factors a company considers when declaring a dividend, namely, profit for the year, expected future operating cash requirements, planned investments, current business environment, and the sector the business operates in. Companies that operate in fairly consistent sectors will more often than not have a consistent dividend payout ratio from year to year. An example would be the banking sector. However, industries such as the mining sector will have a more erratic dividend payment policy, as their earnings fluctuate from year to year, as their profit is dependent on commodity prices, global demand, and exchange rate fluctuations. This slide shows the comparison between the banking and the mining industry average dividends payout ratios. As you can see, the banking industry is more constant than the mining industry. A company needs to be prudent with setting their payment policy, as shareholders will respond to a change from expectation, either positively or negatively, depending on how they perceive the news. 1. A higher dividend payment could mean that the company is unable to find adequate growth projects to fund, or that it is generating surplus cash and is returning it to investors. 2. A lower dividend payment could mean the company is struggling operationally in sustaining cash flow, or they are embarking on a more aggressive expansion and require the additional cash to fund the growth. Stable dividend policy. The stable dividend policy is the most popular dividend policy. Under the stable dividend policy, the company aims for a steady dividend payout every year. It does not change, even if the earnings are volatile every year. The approximate level of the dividend payout is determined by looking at a forecast of the company's long-term earnings. This approach aligns the dividend growth rate of the company with its long-run earnings growth rate. 2. Constant dividend policy. This is set as a percentage of earnings. A company will choose to keep it consistent from year to year, which may be seen as a negative for investors, as they will net benefit from a surge in earnings. A problem arises when a company sits on too much cash that earns only interest, in which case this would affect a company's share price, as investors want growth and to earn more than what they would at the bank for taking on additional risk. 3. Residual dividend policy. These are mainly from companies that have volatile earnings, such as mining. The policy is that earnings left over after paying for capital expenditure and operations is distributed to investors. This is understandable, as investors want to be reimbursed for putting their capital at risk. Thank you for taking the time to listen to our video. We hope to have provided you with more insight to dividend payment policies.